these kind of scenarios. As you all know that when it comes to CA practice, there are many topics which we need to brush up. So there are bits and pieces of each and everything. And here at Optotax, we help you to explore each and every parameter of those arena. And to walk the talk, we are today bringing to you a live webinar on Itr Forms for financial year 21 and 22. Is there any issue with my voice? Because I'm receiving the messages. Ujjwal sir, is my voice clear?
Yes, absolutely.
Okay. Thank you so much, sir. Okay, so moving on. Thank you so much for your reply. Thank you so much, participants. Okay, so now we are going to cover each and every aspect today with relation to this income tax forms of financial year 21 and 22. And we are going to study and dive deep into the changes and alterations in Itr form. And I believe like knowledge here today will be really helpful for our professionals in their offices and also to improve their profession. So I can see people have really started joining, and thank you so much for your this huge participation, because this is because all of your efforts we get motivated to try our best to keep you updated and improve each day at what we do. But I'll just request each and every one of you, if you can please wait for a minute or so that our other friends around India can join as well, because here at Optotax we are a family of professionals who are coming from around India. So let's wait for each and every one of them, because knowledge is no one's perception, right? So we recently organized a webinar series on increasing productivity at work, being efficient and not busy, where we talked about how to automate your office work. And if you have missed it out or you want to revisit it, it is available on our Optotax YouTube channel. So you can go and watch it as per your convenience and time. And if you like it, you can like it. And also please don't forget to subscribe our channel so that you don't miss knowledgeable updates. And now beginning with the today's session, which is brought to you by Optotax, which most of our professionals are already using. But those who are new to the family, let me just brief about it to all of you. We are a technology and knowledge platform, and we in our journey have always tried to make your GST compliance seamless and hassle-free in your offices. Optotax has been engineered for your empowerment and benefit. Optotax is India's #1 and biggest GST platform, and now we have become a family of 60,000 tax professionals who trust Optotax for their 1 million plus clients. So you can also give it a try. It's free and efficient. Good evening, Raghuram ji. Prema ji, I guess audio is clear. There should be some issue at your end. So please, if you can check at your end. So because receiving the response that my audio is perfectly clear. Good evening, Ajay ji. Hope you and your family is living a healthy life. Good evening to all the participants. Good evening, Rohit ji. Good evening, Advit ji. Okay. So now coming back to today's topic, we are going to discuss about changes in Itr forms for financial 21 and 22. And it will be summed up by our faculty, who is well-known faculty on this Optotax profession. He is a 5-star faculty indeed. CA Ujjwal Jindal ji. He is a first-class commerce graduate from Delhi University and an associate company secretary and a practicing chartered accountant. He has also done investment foundation program certified from CF Institute and completed various courses in relation to finance, valuation, accounting, taxation, budgeting, corporate laws, auditing, management accounting, strategic management, other legal and allied matters from renowned universities and institutes located around the globe. He is a founder at UJ & Co Chartered Accountants and co-founder at UJ Legal LLP, and is also experienced in the field of direct and indirect taxes, corporate laws, allied laws, and capital markets as well. He is also a content writer at Taxman, CA Club India, Tax Guru, newsletter, and journals of ICI and ICSI. And also he is a speaker, consultant, and tax expert with various platforms. So it's always a great pleasure to have such a knowledgeable personality and young personality like you, because here at Optotax we have taken an oath to impart knowledge to all of our professionals around India, and with you as a speaker, so it's very much justifiable. And today as well, I and all our viewers are eagerly waiting for your kind deliberation on changes in income tax form for financial year 21 and 22, because we all know how much crucial it is for chartered accountants to know about income tax forms in thorough and in detail. So I won't take much time anymore, and I'll just forward it to you for your kind deliberation. So thank you so much. Ending on a note. So thank you so much for being a part of this webinar yet again and giving us this opportunity that we get to share this stage with you. And now I just hand it over to you for your kind deliberation. So over to you, sir.
Thank you so much, Rohit, for this wonderful introduction and a warm welcome. And I would like to thank Optotax for inviting me once again for a deliberation. It has been some time that we have been doing webinars with Optotax, and last year on the very same topic, we delivered a deliberation. That was also based on somewhere around the new forms that were there. But last year, the portal had various issues. So our prime focus was to help the professionals in filing their client's return. Today, the portal and everything, the operational stabilities have been achieved at the income tax portal. However, there may be few, but still more or less everything has been made right. But as we see from the finance acts that are being announced year after year, there are time and again many changes that come in, and based on the same, the ITR forms are updated time and again. This time also, because of the Finance Act 21 and even some provisions of Finance Act 22, the ITR forms have been updated once again. And there has been a change from all the forms, like for ITR 1, 2, 3, 4, 5, 6. Today, we are discussing all the changes that have been incorporated in ITR 1, 2, 3, 4, 5, and 6. So primarily, I would say that these changes are of not much, they are not much of a legal obligation, legal things that have changed much. Some are operational in nature, like the disclosures and everything has changed up to an extent. To an extent, even the laws have changed up. Even to an extent, the compliances have changed up, like for what circumstances or for what persons filing of ITR is made mandatory. Even we came across a new rule, that is Rule 12AB, that has been taken power from the 7th proviso to Section 139(1), and that has been made applicable starting from 21st of April 2022. So taking everything right in cognizance, there are certain changes that are really important. We have covered today in the webinar all the changes, all the updates, all the deviations that have been made from the previous forms to the new forms. There are a number of changes that are there, and I have tried to accumulate each and every one in today's presentation. But there always remains a scope of extra coverage, and I would appreciate each and everybody if I miss any point, so they can bring it to light to me, and we could definitely discuss that in this session today as well. However, due to brevity of time, there may be circumstances that I'll not be able to take all the queries that you give up. So on the email or on the chat box or even on the YouTube video that is updated, or even on the Optotax channel like Twitter, Facebook, and everything, you can post those queries and we'll be more than happy to help. Not taking much time now. It's a big presentation today, like around, if I say, in effect, it would be like 50 slides, but we'll be discussing in-depth provision, in-depth, and it would be very beneficial for all professionals, not just CS, even CS, CMAs, and even advocates are also into the same profession of filing income tax returns for their clients. So it is beneficial for all. And over that, I came across many people also, like the layman was asking me that your webinar is like much of a benefit to us also, as you're discussing the ITR forms. So even they must be our attendees today. And I have made this presentation not so technical so that everybody could understand. So let us start the presentation now. Okay, so we are discussing about the ITR forms for the financial year 21-22. That is the assessment year 22-23. These are my few details. You can take a note of them. I'll also show all the details at the end of the session so that you can contact me if anything is needed. Coming towards first the scope and coverage of the today's sessions, as it is very much evident from the promotional campaign that Optotax was running on a daily basis for 10 days, that we are covering we are analyzing and understanding the recent insertions or the updation in the income tax return forms for the financial year 21-22. That is the assessment year 22 and 23. Then we'll cover for the detailed analysis of the relevant provision. See, seeing the changes is not sufficient until and unless we understand the background of the provision that has made the change happen. So in this session, we have also covered the background of the provision so that everybody could understand why such change was actually made. Then we'll also cover the key changes in the reporting requirements. Reporting and disclosures has been a new trend that the government has adopted to catch on compliances. So reporting requirements has really increased with this financial year, and even in the coming time, you can see even the AIR, that is annual information report, that is also based on the information that is accumulated from various banks or other authorities. So government is time and again focusing on getting more and more information by way of disclosures. And that is why there was a need to discuss the key changes that came in for the reporting requirements. And last but not the least, the question answers. If time remains, we'll definitely take up the question answers. Coming first, we are discussing various ITR forms. Now, everybody is like, even the professionals are very much clear that which ITR return form is meant for whom. But there are certain I would say there are certain times that we are like in a position to not decide appropriately that what form we should go for. So I have just covered a gist of everything, like what form is meant for whom. So we can just have a quick look at this. However, there are certain rules that are there in the Income Tax Act or the income tax rules, based on which you have to finally decide upon which ITR form you should choose in for. But as a preliminary thing, I have covered the discussion entirely. And let us start with the first return form, that is the ITR One. Basic to all, common to all, mostly filed. ITR One is for individual being a resident other than not ordinarily resident, having total income of up to 50 lakhs, having income from salaries, one house property, other sources, that is interest, etc., and agricultural income up to rupees 5,000. He should not be an individual who is either a director in a company or has invested in unlisted equity shares. Or he should also not be, the person should not be filing ITR 1 in case where TDS has been deducted under section 194N, or if the income tax is deferred on ESOPs. We'll be discussing what is this income tax deferred on ESOPs. I have covered this. This is also a change that has taken place. A specific reporting requirement has been created. So ITR 1 is Sahaj or very basic, and that is why the reporting requirements are quite clear. And the details that are coming up on the screen, they define it that for these people or for residents or for having this much of income, this particular return is meant for. Coming towards ITR 2, we'll quickly cover this portion. ITR 2 is for individuals and HUF. ITR 1 was not for HUF, it was just for individuals. So ITR 2 is for individuals as well as HUFs, not having income from profit and gains of business or profession. So this much has been written in this return form. However, this is a preliminary or primary description that the government has given, and they have added something very particular that every professional should check in. That is, please see Rule 12 of the Income Tax Rule 1962. At the end of the session, we'll see what this Rule 12 actually is. But Rule 12 is very important. That is a primary driver for you to decide which ITR form would be applicable to your client. So again, we go for ITR 3. Next, for individuals and HUF, again, having income from profits and gains of business or profession. So ITR 2 was meant for all individuals or HUFs not having income from PGBP, and ITR 3 is for people who are individuals and HUF that those are having income from PGBP. Again, Rule 12 comes into picture. Coming to ITR 4, that is Sugam, for individuals, HUFs, and firms. Now, when we say firms, it means not the sole proprietary firm, because they are already covered in the meaning of the individual thing only. So when we say firm, they are partnership firms other than LLPs. So LLPs have a character of a partnership firm otherwise with a limited liability. But ITR 4 cannot be filed in, that is presumptive taxation cannot be applied in for LLPs. They have to mandatorily go under following full accounting and go under ITR 5. So ITR 4 is meant for partnership firms only and not for LLPs, along with individuals and HUF. Being a resident, having total income of up to 50 lakhs and having income from business and profession, which is computed under section 4480 ADA AE. So AD is business, ADA is profession, A is for flying of goods hire people. Not for an individual who is either a director in a company or has invested in unlisted equity share. So when it is said that a person has invested in an unlisted equity share, so if he's a director in a private limited company, there might be a circumstance that he is not a subscriber to its share capital. So he has to be a subscriber to its share capital, and then he would be someone who has invested in unlisted equity share. So both the cases, either he being a director or he being a subscriber to the shares of an unlisted company, in those cases, he cannot file ITR 4. He have to go either in for ITR 2 or ITR 3, whatever is applicable. Again, that ESOP limit is there. If income tax is deferred on ESOP, then also you cannot file ITR 4 or has agricultural income of more than 5,000. That is, if up to 5,000 income, you can still file ITR 4, but if it exceeds 5,000, then you have to switch to again ITR 2 or ITR 3. Then coming forward to ITR 5. Now, ITR 5 is for persons other than. So this is a negative statement that they have prepared a negative list for the persons who shall not be filing ITR 5. So ITR 5 is not meant for individuals first, because ITR 1 to 4 is already for individuals. So 5 is kept separate from individuals. Next is HUF. Again, HUF will file 2, 3 or 4. So not meant for HUF again. Then for a company, because company will be filing 6. So company has been reserved aside, and for person filing form ITR 7. So they have specifically stated that whatever is left out, so they all will file ITR 5. And who will file ITR 5 otherwise? The LLPs or the partnership firms as well, who are not adopting the presumptive taxations. Even in this, you have to see Rule 12. So Rule 12 becomes a very profound thing before you have decided to file which return form for your client. So you have to always see Rule 12 before you start to file returns for your clients. Then moving towards ITR 6. ITR 6 is for companies other than companies claiming exemption under Section 11. So if your company is not claiming any exemption, if your client's company is not claiming exemption under Section 11, then ITR 6 is for you. Again, Rule 12 comes into picture. And last but not least, the ITR 7. So ITR 7 is for person including companies required to furnish return under Section 139(4)(a), 139(4)(b), 139(4)(c), 139(4)(d) only. So this only word makes person including companies. So this is for Section 8 companies basically, and for trusts, other organizations. We have primarily focused our discussion for today from ITR 1, starting from ITR 1 to ITR 6, whatever the changes that come along. I can also show you up the ITR forms, but I guess it's more resourceful if we discuss what the changes have actually came in, and when you will see those ITR forms yourself, because it's a brighter picture, I guess, to discuss the changes in detail. And then seeing the ITR form, you can very well correlate that whatever change we discussed is there present in the ITR form. I have all the forms. If you wish to, at the end of the session, we can also have a glance quickly at the forms that are coming up. I may miss, there are like 50 slides more that we have to study up. So I may miss out a certain like the updations that have been there that are not of much importance, that they are related to IFSC or something like that. I may miss, but I'll try to cover each and everything so that everybody is benefited completely. Again, for ITR 7, you have to see Rule 12. Moving towards our primary discussion. So this discussion I have made, I have accumulated or seen all the return forms, and I have made a conclusion that there are certain changes that are common to this return, or it is specific to this return. So what I have made is I have broken this discussion into various limbs. So everything has been accumulated under an umbrella which talks about changes common to. So when I talk about changes common to, these all changes would apply to all the returns that have been mentioned. So we are starting with ITR 1, 2, 3, 4. Whatever changes we are discussing in for now, they are common to all 4 return forms that are in place. So moving towards the first change. So first change talks about nature of employment for pensioners that is further classified, is further categorized. So as and when we see from the drop down in the nature of employment, when we are filing for a return of our client, we see the nature of employment tab, and under the same tab, an individual receiving pension has to choose the option pensioners if he is a pensioner. Now, further categorization has been declared up in the new ITR forms. That is, the person has to state that whether he is a pensioner from central government, or he is a pensioner from state government, or he is a pensioner from PSU, that is public sector undertaking, and if he is a pensioner other than these 3. So a classification has been made, no much of a resource or a stance, but the classification has been detailed. Now you have to ask in for your specific clients that what organization do they belong to be a pensioner. And this is also common to ITR 1. So where the name of the company and everything is not visible, even in that cases, you have to take these details from your client and ask which government department does he belong. So if it's CG, the central government, state government, PSU, or others. So just a minor change, but of much importance. Moving towards the next change now, that is relief under section 89A from taxation on income from retirement benefit account maintained in a notified country. So what the things were, where a non-resident became a resident in India, the amount of income in his foreign retirement benefit account is chargeable to tax in India on an accrual basis. However, some countries tax such an account at the time of receipt. Due to a mismatch in the year of taxability of such income in their retirement fund, the taxpayers, who are generally the non-residents, face difficulties in availing of the foreign tax credit in respect of tax paid outside India on such income. So a person is a non-resident, he is getting converted into a resident, that is, he is moving permanently to India. And in that case, he has a pension account that is running, or the retirement account that is running in the foreign country. And now whatever the fund is going to come or from that particular account would be chargeable to tax on an accrual basis in India. And the governments there in the notified country or the foreign country, they tax that particular amount in on a receipt base. Few tax them in on a receipt base. So there is a mismatch of the timing, or the timing difference is there, and due to which the foreign tax credit cannot be availed, because as till the time the tax is actually paid, you cannot claim up for the foreign tax credit. And that is why this provision came into force, that section 89A inserted with effect from assessment year 22-23, that is financial year 21-22, removed the aforesaid difficulty by providing that the income of a specified person from a specified account shall be taxed in such manner and for such year as may be prescribed by the rules. The board has not notified any rules yet. However, they have made a change in the ITR for sure this time, and that change is common to ITR 1, 2, 3, and 4 to take care of this thing. So what that change is all about. However, the new ITR form has amended Schedule S that talks about the scheduled salary to disclose income from retirement benefit account maintained in a notified country under section 89A, and income from a retirement fund maintained in a country other than the notified country under section 89. So in both cases, this amount would stand taxable. However, if it's in a notified country, then the relief would be available. If it is not in a notified country, then relief would not be available. The eligible taxpayer is allowed to claim a deduction of income claimed for relief from taxation on the application of section 89A. However, it is not clear yet how such a deduction shall be computed. A similar disclosure has to be also made in schedule other sources if this amount is received as a family pension and not as a general pension or a retirement pension from that particular person. If his family is receiving, then they have to make this disclosure in other sources. So this is a new disclosure that has came in for. However, the computation has not been made clear yet. The principles have been given up that yes, you have to disclose this amount separately in the return, and that is why this the 4 returns from 1, 2, 3, 4 has been updated accordingly. So this is also a change that has came. Next, we are moving towards changes that are common to ITR 3 and ITR 4. So basically for business returns for individuals and HUF. So what is the first change that is coming? That is a disclosure for new or the alternative tax regime under section 115 BS. So from the previous financial year, we have seen that we have encountered 2 tax regimes, one being the old tax regime, which was common from the very time, and the new tax regime that was recently announced and was the first financial year for which the new regime came up, that took off all of the exemptions, mostly all of the basic exemptions, and gave you a reduced tax slab. So if you have basically opted in last year, or you wish to opt this year for that particular regime, there are certain number of disclosures that you have to make. Also, you have to file form 10IE that you must have filed last year for your clients. So the following disclosures are required in ITR 3 and 4 in respect of the new or alternate tax regime of section 115 BAC. Whether the assessee has opted for alternate tax regime under the section 115 BAC and filed form 10IE in AY 21-22. So that is what the question will appear in the return, and you have to select accordingly. And you have to also mention the acknowledgement number of form 10IE. Now this would be auto-populated. I mean 99% it would be auto-populated. However, In certain cases, it might not auto-populate. Then you have to enter this particular acknowledgement number for Form 10IE. What other disclosures have to be made? For the AY 22-23, the assessee has to choose from the following options. You will see these following options in the return form. The first option would be opting in now. That is, earlier you have not opted for the new tax regime or the alternate tax regime, and now from this particular financial year you wish to opt in for this. So there is no precondition that for the previous year, if you have opted, you have to opt in for this year. This option is separate and available every year. You can choose whether, even in employment, you choose this particular option for a particular financial year to a new regime. Then also, while filing your return, you can change this particular option. So this is very much to your own calculation of tax, and which scheme is more beneficial for you. You have to choose it, and that is where you have to select that whether you wish to move now for this particular financial year to this new regime and select opting in now. Or the second option is not opting. That is, you have opted last year, but you are not opting this particular year. So you have to select not opting. Third is continue to opt. That is, you have opted for the previous year also, and you are continuing to opt the new regime for this particular financial year as well. And last is opt out. That is, you have opted in for the previous year, but now you wish to opt out for the same. Not opting can be even applicable to that particular person who has not opted the same scheme for the previous year also, and even for this year is not opting. So they can select this particular option, not opting. For opt out, last year they have opted, this year they are opting out. Continue to opt, the sequence is going on. Opting in now, they have not opted for the last year, and for this particular financial year, they are opting in. So this is what a forehand disclosure has to be made, particular to the new tax regime or the alternative tax regime. The more important part is even the 10IE has been made of much importance. So you have to perform all the filings in time for 10IE as well. Even in BA-B or BA-D, you have to file the 10IF. I will discuss that also, because that is also a change that has came up. So, and the acknowledgement number would also populate in the return forms for this particular previous financial. So this is a change that was common to ITR 3 and 4. That then we are moving to changes that are common to 2, 3, 5, and 6. That is ITR 2, 3, again meant for individuals, 5 meant for partnership firms or for LLPs, 6 for companies. So we are discussing all the changes that are common to these all. Schedule FA, that is fixed asset to be reported of foreign assets held and income earned during the calendar year ending 31st December. So this is a major change that has came in, and even this has ended up various misunderstanding and controversies that were existing in time, place, and we had to discuss every time with the client that whether this particular asset is in this reporting period or that accounting period. So all that has been negated now, and even the ITR form has been devised in such a way that this reporting can very well be defined up. So let us understand what this reporting actually is first. So the ITR form, except 1 and 4, that is the simpler ones, applicable for the assessment year 22-23, required a resident taxpayer to disclose his foreign assets in Schedule FA, that is fixed assets. Reporting is required even if the taxpayer is a beneficial owner of such foreign asset or has a financial interest in a foreign entity. Disclosure in Schedule FA of the various foreign assets such as foreign depository account, immovable property, trust created outside India, etc. is required. The reporting requirement is mandatory only for a taxpayer who is resident in India. It is not required to be filed up for a taxpayer who is not ordinarily resident or is a non-resident. So whenever I'm saying that it is specific to a resident, so I'm always talking about being ordinarily resident in India. So because specifically the section has excluded not ordinary resident and non-resident. So Schedule FA in the old return forms required the reporting of foreign assets only if the person has held them at any time during the relevant accounting period. We have always heard the term previous year, financial year, assessment year, but never the term accounting period, specifically in the Income Tax Act. So the accounting period is not defined, has not been defined in the Act as well. However, the instructions issued by the CBDT for filing of ITR forms has provided the meaning of this term. For example, if I talk about for assessment year 21-22, that is financial year 2021, the accounting period means from 1st January 2020 to 31st December 2020 in respect of a foreign asset or account held in those jurisdictions where the calendar year is adopted as a basis for closing of accounts and tax filing. So for those countries or tax jurisdiction where they follow the accounting period to be the calendar year, for that particular period, the accounting period definition should mean the calendar year itself for those particular tax jurisdiction. Okay, so this was thing that we were all following up for the previous time. Now, what things have come up, or what the difficulties were actually, the CBDT has clarified that a taxpayer shall be required to report foreign assets only if such assets have been held at any time during the previous year of India, as also during the relevant accounting period on the foreign tax jurisdiction. So you can, I'm sure everybody could imagine the circumstance, because one country follows calendar year and second country follows the accounting term of April to March. So this is where the variance was coming up, and every time things were not consistent, because relevant accounting period would mean accounting period for that particular tax residency, and that would mean the calendar year, or even certain different years, because everybody is not following up the calendar year thing. And previous year for India would always be April to March. That is the accounting period for India. So I have taken an example here, if you can see. For example, in the example cited above, that we talked about the AY 21-22, that is 1st January 2022, 31st December 2020, Mr. Rocky. So I've taken the name Rocky, inspired from KGF title this time. So Mr. Rocky has acquired a flat in UAE, United Arab Emirates, in January 21 and sold it in March 21. For the previous year 21-22, the relevant accounting period will be 1st of January 21 to 31st of December 21. Why this is so? Because UAE follows the accounting period to be a calendar year, and for that particular reason the accounting period would be on the foreign tax jurisdiction, and that would accordingly be 1st of January 21 till 31st of December 21. The transaction of purchase of flat falls in the relevant accounting period. Thus Mr. Rocky is required to report such foreign assets in ITR though the same is not held in the previous year 21-22. Now, if you observe this, in the previous year, you have to report this particular item as a foreign asset, but instance, it is not happening up every time. So to cut this, or to make this more clearer, the income tax, the CBDT department has made up this particular change coming in from the new ITR form. They have replaced the expression accounting period with the calendar year ending as on 31st December 2021. So now accounting period thing specific to tax jurisdiction, etc., has gone out. We have entered in for a much clearer meaning, which means calendar year ending as on 31st December 2021. So for all countries or tax jurisdiction, we'll just focus upon the calendar year. This change implies that the assessee shall furnish the detail of foreign assets held between 1st of January 2021 and 31st of December 2021 in return to be filed for the financial year 21-22 or the assessment year 22-23, irrespective of the fiscal year followed in that particular foreign country. Like in Australia, we see Australia, Kenya, Mauritius, Nepal, Egypt, they follow July to June. So their financial year starts from 1st of July and end on 30th of June. We talk about countries which are Thailand or Virgin Islands, they follow the financial year to be from October to September. That is 1st of October and ending on 30th of September. So this was all a chaotic situation. However, now we are clear with the term calendar year ending on 31st of December. So the reporting is to be made if the specific foreign asset is held as on 31st of December 2021. This change removes all scope of misunderstanding or miscalculating the reporting period. So let us understand this better with an example. I have prepared 2 examples for this. I guess everyone would be very clear with this particular change. So illustration 1, we talk about the relevant previous year, that is the PY, that becomes 1st of April 2021 to 31st of March 2022. In the financial year, we have to file the return form. Relevant calendar year for this particular financial year becomes 1st of January 2021 to 31st of December 2021. So for this period, whatever foreign assets are held, you have to report in this particular previous. Date of purchase of share of Apple Inc. or a flat. So say suppose a person has purchased shares of Apple, or he or she has purchased a flat on 11th January 2021. So is this assessee required to furnish the detail of the foreign asset acquired So the answer becomes yes, because the period, the calendar year that ended on 31st of December 2021. So in this particular financial year, he has bought this particular assets, and that is why the disclosure becomes essential or necessary. The assessor is required to furnish the details of Apple Inc. share in ITR applicable for AY 22-23, even if he has not held the foreign asset in the relevant previous year. So in the relevant previous year, that is 21-22, we see it's 11th January 21, and the previous year starts from April. So even before the time for the 3 months, January, February, March, if he has purchased or sold any of the asset, the disclosure becomes mandatory, and that is the bigger change. Talking about an illustration 2 on the very same premise, say relevant PY remains the same, relevant calendar year remains the same, but now date of purchase of shares of Apple Incorporation or a flat becomes 11th January 2022 as against 2021 in our previous example. So in this case, is the assessor required to furnish the details of the foreign assets acquired? The answer becomes no. Why? Because the calendar year that ended on 31st of December 2021, the particular individual or assessee was not holding these shares, and that is why the previous year has no sense. Now only we have to see for the calendar year, and that becomes the answer. The share of Apple Inc. were required within the previous year, but after the end of the relevant the calendar year. Thus, the assessee is not required to furnish the details of the Apple Inc. share in the ITR applicable for AY 22-23. However, he will disclose these particular things in the next year's next assessment year ITR, that is AY 23-24. Clear with this? I guess everybody would be very much clear with this example. Moving towards the next thing, that is additional disclosures in scheduled capital gain. So new ITR form require the following additional disclosures in the scheduled capital gains. Now, if we have filled in for the capital gain forms in the past for our various of our clients, we see ourselves that there were many inconsistencies where we feel that the government cannot track it, that when the asset was purchased or when the asset was sold or how the indexation has been performed. So this was all the assessee that was doing himself, and there was no more to check it, like cross check it by the government. So whatever disclosures of things that are coming up, that is just for the sole reason they have devised up a software or thing that would auto calculate or auto check those calculations that you have performed. And that is why everywhere they are asking for certain disclosures. And also in the schedule of capital gains, they have asked for disclosures of date of purchase and sale of land or building. So if it has been made mandatory to furnish the date of purchase and sale of land or building, if the income arising from transfer of a taxable is taxable under the head capital gain. This additional disclosure would help the tax authorities to verify the eligibility of the assessee and the allowability of exemption under section 54, 54 EC, 54F of the Income Tax Act 1961. So you can see that they are all doing everything just to ensure consistency of information and to verify that whatever things you are claiming or doing, so they are in place. Next is country and zip code if the property is situated in a foreign country. So it was mandatory already. It was mandatory to furnish the ITR form, the details of the buyers and the address of the property transferred. I am sure everybody of you must have entered in the previous ITR as well for your various of the clients who have been selling or buying these particular properties. The new ITR forms now require the country code and zip code to be entered as well if the property is situated outside India. So additional disclosure requirement has been made for this particular asset. Next is disclosure of FMV of capital assets and consideration received in a slump sale transaction. Whenever I say FMV, that means fair market value. The Finance Act has amended section 50B to provide that in case of a slump sale, the FMV of undertaking or division transferred shall be deemed as the full value of the consideration received or accruing as a result of transfer of such capital asset. CBDT was empowered to prescribe the method of determination, the FMV of such undertaking or division. And with that, they came in with a new rule, that is 11 UAE. In exercise of such power, CBDT has inserted a new rule 11 UAE. It provides that the higher of the following on the date of slump sale shall be deemed as the full value of consideration. Now, what would be deemed as the full value of consideration? First, FMV of the capital asset transferred by way of a slump sale. So this was every time in place. Second has came up, fair market value of the consideration received or accruing due to transfer by way of a slump sale. So whichever would be higher would be taken as the FMV of the consideration for the slump sale purpose. The new ITR forms require reporting of FMV calculated as per this rule 11 UAE. So again, ITR has been made consistent just for the calculation for the purpose of slump sale under this provision. Moving towards the next change, that is year-wise details of cost of improvement to land and building. So this was very obvious. We all prepared this schedule ourselves, and finally we used to pour in this value as cost of improvement, the indexed cost of improvement, in fact. So now you have to give details year-wise for whatever cost of improvement is happening, and therefore we should always ensure that there are certain or adequate proofs that are available with all our clients, because now the government can check the cost of acquisition year-wise. Even earlier also they could have checked, but now you have to make the disclosure year-wise, and that is where the disclosure requirements is more profound now. The necessary required to give year-wise details of the cost of improvements, if any, incurred on the land or building transfer during the relevant year. The new Itr form therefore seek the following additional information from the taxpayer, there being first the cost of improvement, second year of improvement, and third cost of improvement with indexation. So this is a major switch that has come in, cost of improvement along with cost of improvement with indexation, so that you are applying in for the CII, that is the cost inflation index, correctly. So that is where the disclosure has been made 2 times. So you have to enter in the value for cost of improvement first, then year wise also you have to enter, and then finally you have to enter the total summed up index value as well. These details are required to be given year-wise if the assessee has incurred the cost of improvement in different financial, obviously. And cost of improvement mostly is always year-wise, because time and again you are spending on the property to make it more and more better, and that is where you add up for different financial years. Separate disclosure of cost of acquisition and indexed cost of acquisition. Even for this, they have made the things very clear that for cost of acquisition, you have to disclose the amount, and then you have to disclose the amount for index cost, so that you are applying the CII right. So in the previous year, in the previous Itr form, the assessee was required to disclose only the indexed cost of acquisition of property transferred, but now you have to also disclose the cost of acquisition along with index cost of acquisition. Only in case of long-term capital assets. Only short-term, the indexation benefit is not available. So this was all about this. Moving towards the next change, that is dividend income taxable under section 222E to be reported separate. Now, what is 222E? We have all studied about deemed dividend. So what deeming provisions have been made on dividend, you have to make a separate disclosure for the same. Now, why this has to be done? Let us understand first what is 222E. Any payment by way of a loan or advance by a closely held company. When we talk about a word closely held company, what does it mean? Does it mean a private limited company or a public limited company? So I may ask everybody here, just for the sake of participation, what do you mean by the meaning of the term closely held company? You can reply everybody in the chat box. Quickly. We don't have much time. I mean, is it a private limited company or is it a public limited company? Okay. Few say that it's private, few say it's holding. Okay, so there are mixed replies. More or less, everybody is focusing on private limited company. Okay, everybody, thanks for your participation. So let me now disclose the real answer. So basically, if I talk about closely held company, it means both the companies or all the companies together. By closely held, even a public company can be closely held. Say you need 7 subscribers to incorporate a public company. I'm not talking about listed company. I just said public company. So if I talk about a public company, you just have 7 subscribers, and those 7 subscribers could be your members or friends. And that's where it becomes a closely held company. However, if we talk about Companies Act, keeping aside the Income Tax Act, so there also the meaning of closely held company changes to an extent, because MCA or Ministry of Corporate Affairs, read with the company's provision and company rules, treats every public company to mean a public company which is not closely held. Because for closely held company, the norms for the registration with RTA and everything is very different. So there the distinguished meaning is very clear. However, for the purpose of income tax, they are meaning all companies which are closely held, in stance that all the share capital or the control or power is held by certain few members who control all the affairs, and the shareholding is not distributed widely. So if any loan has been passed on, or loan or advance has been given by such a closely held company to a shareholder who is a beneficial owner of 10% or more equity share capital of the company, or to a concern in which such shareholder has a substantial interest, When we talk about substantial interest, it's 20% or more. When we talk about beneficial interest, it's 10% or more. Is deemed to be a dividend to the extent it is covered by the accumulated profit, excluding the capitalized profits. So this is in the nature of a deeming dividend. So whenever any loan is passed on, so that justifies or means it can be a commercial advance. In that particular case, this section would not come into picture. That the Supreme Court judgment and various court judgments are on there, or are there in place. That if an advance is given to such a person who is basically receiving this advance, even if he is a beneficial owner, but he is somebody who has taken that particular thing as a commercial advance for having such activities on behalf of the companies done, as a director or a subscriber can do. So in that particular case, this certain clause would not apply, but in all other cases, this would be deemed as dividend. And when it would be deemed as dividend, what will happen? Until last year, there was no separate disclosure of dividend income taxable under 222E, as entire dividend has to be poured in. Total amount of dividend received by a taxpayer during the financial year is clubbed and reported in schedule other sources. This used to happen before. Now the new ITR form seeks separate reporting of dividend income taxable under section 222E. So what you will see is dividend and dividend specific to 222E. The section would be mentioned in the ITR return form, and this is common to all ITR return form 2, 3, 5, and 6. Next change. Changes common to ITR 2 and 3. That is for individuals, and again for individuals having income from PGBP. So not PGBP and PGBP. So what are these changes? Reporting of interest accrued on PF to which no exemption is available. So the Finance Act 21 has amended section 10, 11 and 10, 12, clause 12 to provide that no exemption shall be allowed in respect of interest income accrued during the previous year in the recognized and statutory provident fund to the extent it relates to amount or the aggregate of amounts of the contribution made by the employee alone exceeding rupees 2.5 lakh in any previous year on or after 1st of April 2021. So if an employee is making a contribution exceeding rupees 2.5 lakh, then the interest that is earned on that particular amount, that would stand taxable and that would not get exempt. So this was the change that was made by the Finance Act 20. The interest income accrued in the respect of the employee's contribution over 2.5 lakh shall be taxable under the head income from other sources. However, if such person has contributed to a fund in which there is no contribution by the employer, the limit of 2.5 lakh shall be increased to 5 lakh. The method of computation of such interest income has been prescribed in Rule 9D. So if there is employer contribution, then that limit would stay 2.5 lakh only for the interest exemption. However, if there is no employer contribution, then this limit would get doubled, and then 5 lakh would be contributed and the interest would stand tax free. In the new ITR form, the schedule other sources has been amended to incorporate, just give me a second. Yeah, in the new ITR form, the schedule other sources has been amended to incorporate the reporting requirement of such interest income. So the reporting requirement has been made very clear. If there is any interest that is coming up from the rate being more than 2.5 lakh, then in that particular circumstance, the disclosure of interest has to be made separate. Okay. So this was also a major change that we will see in the return forms. New schedule for reporting tax deferred on ESOPs. So this was a thing that was there in the ITR 1 description, ITR 4 description, that people who have deferred this particular tax on ESOPs, they cannot file ITR 1 or 4. So what is it exactly? And that is why this change is common to ITR 2 and 3 and not to other ITR forms, because they cannot even file that particular return if this particular thing is getting applicable on them. An employee can defer the payment or deduction of a tax in respect of shares allotted under ESOPs, that is Employee Stock Option Program, specified security by an eligible startup referred under Section 80 IAC. The tax is paid or deducted in respect of such ESOPs within 14 days from the earliest of the following period. So this is a deferment provision basically. Tax is there, tax has to be paid, but there is certain deferment. After the expiry of 48 months from the end of the assessment year relevant to the financial year in which ESOP was allotted, so it's 48 months deferment, from the date the assessee ceases to be an employee of the organization, or from the date of sale of shares allotted under ESOP. So within 14 days from any of this particular circumstance that is happening first, the tax has to be paid in. The part B of schedule TTI, that is computation of tax liability on total income in ITR forms of AY 21-22, show the disclosure of the tax amount deferred in this respect. Okay. So what is the new thing that has came in? That was already existing. The new Itr form has inserted a schedule. Special schedule has came up, just like ATD came up for the previous time, for the very first time, like from the last to last period it came in. So schedule tax deferred on ESOPs has came up. This schedule seeks the following disclosure: amount of tax deferred in the ITR for the AY 21-22, that is the previous financial year, date of sale of specified security and amount of tax attributable on such sale, then date on which he ceased to be an employee of the organization, amount of tax payable in the current assessment year, if any, balance amount of tax deferred to be carried forward to the next assessment year. So you see that all these requirements or all these reportings are in consistency of the provisions that have been made applicable. For the first 3 points of this particular slide, you can see that they are exactly what the changes have been made, and that is why the same has been asked in to be reported in this specific schedule. Also, the government is specifying or focusing primarily to report the amounts that the tax stands payable, or for the coming time the tax would be payable. So the deferment amount that has to be also be get disclosed. At the outer limitation period of 48 months from the end of the assessment year relevant to the financial year in which ESOPs are allotted is not yet over, the employee shall be liable to pay tax deferred in the assessment year 21-22 in the previous year 25-26. So it's just about the provision, nothing new, just what the new thing that has came up with that, the scheduled tax deferred on ESOPs, and that is why you have to take in all the details from your particular client with regard to this particular deferment. A new schedule has been inserted to keep track of the amount of tax deferred by the employee and the year it should be taxed. The tax payable in the current assessment year is exported in a new row introduced in Schedule Part B TTI in the new income tax return form. So that is why the reporting has been specifically, or this schedule has been particularly inserted. Moving towards the next change, mandatory to choose suitable option for residential status in India. Now, residential status in India was earlier also a thing that every professional or every person could not decide that whether he's a resident in India because of this condition or that condition. Even a profound list of rules has came up, and you could see number of conditions coming up to decide whether you are resident or not, ordinary resident or a non-resident. So what is this exactly? Determining residential status in India is quite a tedious exercise. The new ITR gave a suitable description of different clauses due to which the residential status is determined. These options are self-explanatory, however, because entire description is coming up whenever you are selecting a particular option. The assessee has to choose the relevant option in support of his selection of a residential status, and what there would be options like resident and ordinarily resident, then resident but not ordinarily resident, then non-resident. So they have to choose the conditions, everything that would be there in the return forms. I have not stated that all in this slide because again the load on the slides would have increased, and even before that it is like beyond 50 or 60 slides. So there would be 3 conditions. You have to choose one to decide, and accordingly the computations would follow. Next, changes common to ITR 3, ITR 6 and hidden ITR 5. So why I have hidden it? In the last limb, I would discuss that why I have also mentioned ITR 5. Adjustment of unabsorbed depreciation from written down value of the block as on 1st of April 2020. So an assessee opting for 115 BAC is not eligible to set off the unabsorbed depreciation attributable to additional depreciation. Such unabsorbed depreciation relating to additional depreciation which has not been given full effect to shall be adjusted to the written down value of the block of asset as on 1st of April 2022 in the prescribed. So if you are switching your regime, you are going into a new regime that has been made available, you have to give up certain of the exemptions or deductions that was earlier available to you. And one such is unabsorbed depreciation. So where whatever remaining unabsorbed depreciation was there, that has to be scratched up and that has to be given effect to, likewise that has been stated up. Third proviso to Rule 5.1 provides that the WDV of the block of asset as on 1/4/2020 shall be increased by such depreciation not allowed to be set off. So this block value would increase by the amount of unabsorbed depreciation that has not been allowed for now. In the new ITR form, Schedule DPM, that is depreciation on plant and machinery, which deals with depreciation on plant and machinery, has been now amended. It provides the WDV of the block as on 1st of April 2020 shall be increased by the amount of unabsorbed depreciation pertaining to additional depreciation, which was not allowed to be adjusted on account of opting for Section 115 BSE. So this unabsorbed depreciation is the one that is pertaining to the additional depreciation we talk about. That is the 20% thing. So if it remains unabsorbed, then it would be added, and even the scheduled DPM that exists in the return is not allowing you to adjust this particular amount now, and that will add up to your asset thing. Why now ITR 5? Similar change has been made in scheduled DPM of ITR 5 if a cooperative society has opted for the alternate tax regime under section 115 DA. And that is why I've mentioned that this change is even common to 11 ITR 5 as well. So unabsorbed depreciation on additional depreciation that remains unabsorbed, that will be now added up. And how it will be added up in the schedule also, they have given the specific treatment for this. And that is where this is a change that is coming up to these ITR return. Now change is common to ITR 2, 3, and 5. So again, this set we are starting. So individual, then business, then firms. Limiting the rate of surcharge on dividend income. The Finance Act 2020 abolished DDT, that is dividend distribution tax, and moved to the traditional system of taxation where companies or mutual fund do not pay DDT on the dividend, and the shareholder or the unit holder who received such income has to add in that amount of dividend to their income and pay the taxes accordingly. As the dividend income is taxable now in the hand of investors, the Finance Act and Taxation and Other Law Act removed the enhanced surcharge on the dividend income. So this Taxation and Other Law Relaxation Act that came in at the time of COVID, and that is where it removed the enhanced surcharge on the dividend income. Thus, in case of an individual, HUF, AOP, BOI, or AGP, including FPI, that is, and specified category 3 AIF, that is alternate investment fund, and foreign portfolio investor also, the surcharge on tax on dividend income shall be levied at the rate of 10% if it exceeds 50 lakh but is up to 1 crore, and at the rate of 15% if it exceeds 1 crore. So the higher surcharge is not applicable, and the rate of surcharge on dividend is limited to 10 or 15% only. The consequential change has been made in Schedule B, that is TTI, computation of tax liability on total income, to limit the rate of surcharge on dividend income taxable under 11580 and other dividend income as well. So the limitations has been inserted in the ITR return forms, and now the surcharge would accordingly get calculated. So this is also a change that has come in. Now change is common to ITR 3 and ITR 5. So again, profit individual HUF and for firms LLPs. What is this change now? Separate disclosure, income from units located in IFSC in Schedule AMT. So I'm covering this. AMT is payable by a non-company SSC whose regular tax on total income is less than 18.5% of adjusted total income. However, if an SSC is a unit in an IFSC, that is International Financial Services Center, deriving income solely in a convertible foreign exchange, the alternate minimum tax rate shall be 9% instead of 18.5%. So benefits have been given to the units that are located in IFSC, and that is why the AMT limit that was made 18.5% has been reduced for the units that are located in IFSC to 9%. So this was there. The new ITR forms in Schedule AMT have sought separate disclosure of computation of adjusted total income under Section 115 JC in respect of units located in IFSC and other units. Now the income from units located in IFSC shall be reported separately in the Schedule AMT for computing the adjusted total income and tax payable there. Again, a separate disclosure requirement for better transparency and better compliance. This is specific to IFSCs. Now changes common to ITR 5 and ITR 6, that is LLPs and companies and even firms also. Additional disclosure, certain income exempt under Section 10. So there are certain incomes that are exempt under Section 10, and additional disclosure have been given for them. So earlier, no separate disclosure were required for income exempt under Section 1023 FB, FBA, FC, FCA, FE, FF, and D and 4D. But now these disclosures have to be made. I know everybody would be asking what these sections are all about. So not describing everyone in detail, I have made the list and given all these sections that what is meant for them. So there is a Schedule EI, details of exempt income. So you have to disclose all these: exemption to venture capitalist fund or venture capital company, exemption to investment fund and unit holder, exemption to business trust, exemption to wholly owned subsidiary of ADIA or sovereign wealth fund of pension fund, or capital gain from transfer of shares of a company resident in India in account of relocation of offshore funds. In all those cases, additional disclosures have been made in place in the Schedule EI, and you have to make good those disclosures. 10D is exemption to specified fund. Now moving to changes common to ITR 3, 5 and 6. 3 profit and loss, individual, HOF, 5 LLPs, partnership firm, 6 companies. What are these changes? Disclosure in respect of SEP, that is significant economic presence. Explanation 2 to section 9(1)(I) provides that significant economic presence of a non-resident in India shall constitute a business connection in India. For this purpose, significant economic presence shall mean any transaction in respect of any good, service or property carried out by a non-resident with any person in India, including the provision of download of data or software in India, if the aggregate of payments arising from such transaction or transaction during the previous year exceeds rupees 2 crores. Systematic and continuous soliciting of business activities or engaging in interaction with 3 lakh users in India in the new ITR forms. So SEP is established in these 2 particular transactions or these 2 particular cases. And therefore, if the SEP, that is a business connection in India, is established, then in case you have to make additional disclosures in the ITR. In the new ITR form, the non-resident has to confirm if there is a significant economic presence in India or not. If there is SEP, the above mentioned details of transaction and users have to be provided in the ITR forms. And that is where we have to extract this particular information from our clients. This is also a new disclosure requirement that is came. We are seeing a lot of additional disclosure requirement that is came up from these return form. Exclusion of dividend income from the schedule BP. Schedule BP, that is business or profession, that is income, computation of income from business or profession, provides for the exclusion of certain income receipts which are credited to the profit and loss account but are taxable under other heads of income. The list include income receipts taxable under house property. Income from house property is calculated separately. Capital gains calculated separately. Other sources capital they have to be disclosed separately. Section 115 BBF, income from patent, that has to be disclosed separately. Section 115 BBG, that is income from transfer of carbon credits. So all these incomes have to be like basically disclosed separately. And just all these income have to be disclosed separately, and that is why they are not included or they do not form a part of schedule BP. Now again, the dividend income that is there, that will also not form part of schedule BP, and it would form part of the schedule other sources. The new ITR form add dividend in the list of exclusion. It excludes from the schedule BP if it is credited to the profit and loss account. The explicit exclusion of the dividend income from BP is in line with section 56(2)(1), which provides that dividend income is taxable under the head income from other sources. It should be noted that where the dividend is received in respect of share or security held as stock in trade, various courts have held that it should be treated as income arising in course of business, though for the purpose of chargeability, it is included in the head income from other sources. So even if your shares are something that are basically held as stock in trade and not as investment, even in that case where the dividend is getting accrued, you have to show that particular dividend receipts or dividend income in income from other sources and not under income from business or profession. So basically what they are trying to say, they are not allowing expenses from the dividend income. They are making it taxable fully or completely. That is why they have shifted the source from the P&L to the sheet that would automatically calculate the dividend part and to the full amount. So that is the another change. Changes in schedule 80IA and 80IB due to sunset clause. Any assessee who is deriving profit from eligible business can claim a deduction under section 80IA or IB. Due to sunset date, the deduction under this section is not available for certain businesses like telecommunication services, revival of power generating company, cross-country natural gas distribution, multiplex theatre, etc. Schedule 80IA and IB have been amended to remove the rows allowing deduction under the above obsolete provision. Nothing much of a resource. These provisions have been deleted now because there was a sunset clause that was applicable to them. And as they are deleted, even the schedules have been updated accordingly. And now you cannot claim up deductions going under these particular rows because you will not see them in the return. Just a minor small change. Total secondary adjustments made to be disclosed. Now, this is something that will relate to transfer pricing. Section 92 CE provides that an assessee shall be required to carry out secondary adjustment where primary adjustment to transfer pricing has been made. If due to primary adjustment, there is an increase in the total income or reduction in loss of the assessee, the excess money shall be deemed to be an advance made to associated enterprise and the interest on such amount shall be computed. Section 92CE2A also provides that where the excess money has not been repatriated in time, then the SSC will have an option to pay additional income tax at the rate of 18% per surcharge as applicable on such excess money or part thereof. The old ITR forms requires the detail of such tax on secondary adjustment. I'm sure everybody has seen tax on secondary adjustment to transfer pricing was always available in the return form. In the new forms, the schedule TPSA provides that the SSC needs to indicate the total adjustment made in respect of all the assessment years together. Just an aggregation has to be done. Earlier, we used to make it like time-wise or year-wise. Now, total secondary adjustment made has to be disclosed at once in the ITR form that we are filing. Section 43B specified that certain expenditure are allowed as deduction only on actual payment, even if the SSC follows the mercantile system of accounting. However, these expenditures are allowed as a deduction in the year of accrual if the payment thereof is made either in the previous year itself or in the subsequent year or before the due date specified in the filing of return period. Again, this is all specific to, and this all also has to be disclosed in the ITR this time as a total secondary adjustment. The new ITR form inserted a new row. The new row has the term other information requiring the assessee to disclose the amount of interest or any loan advance from a deposit taking NBFC or systemically important non-deposit taking NBFC, which was disallowed in the earlier year but is allowable during the previous year. This is again a specific thing that has to be reported in for just a aggregation of the reportings that we were earlier making. So that is where the entire thing has to be reported in the return forms, that is 3, 5, and 6, that wherever this particular adjustment is applicable. Separate disclosure of interest and dividend taxable under section 115 AC. Schedule SI, that is special income, seeks details of the income chargeable to tax as special rate. Earlier, this schedule required the combined disclosure of total income taxable under section 115 AC, that is income of a non-resident from bonds or GDR purchased in foreign currency. Now, the new ITR form has amended the schedule SI to seek separate disclosure of the following income taxable under section 115 AC. Again, separate disclosure. So, disclosure coming up, income by way of interest received by a non-resident from bond purchase in foreign currency, then it would be GDR purchase in foreign currency. And further, a residuary clause has been also inserted in schedule SI to report any other income that is taxable at a special. So bifurcation has been made. Earlier, we used to report entirely everything under one section, under one head or one box. So now for GDR, for bond purchase in foreign currency, and for other residuary thing, you have to report everything separately. Additional information from assessee not opting from presumptive tax. Audit under section 44AB is mandatory if the total sale turnover or gross receipt from a business exceeds in the previous year rupees 1 crore. However, if the cash receipts and cash payment do not exceed 5%, the limit would increase to exceed rupees 10 crore during the financial year. For the purpose of computing the limit of 5%, payment or receipt by check drawn or payment of whichever is not an account pay shall be deemed to be payment or received in cash only. The old ITR forms required the assessee to furnish the response regarding cash receipts and payments only, and it did not consider the receipt or payment through non-account pay check or DD. So here what it is saying that if it's a non-account pay check, then it would be considered as cash only. And that is where the limit or the disclosure requirement of section 44AB in the return becomes very important, because the tax audit limits would automatically change. Then the turnover hit limit would automatically change. The following additional disclosures are therefore required in the audit information section of the return 3, 5, and 6. Whether total sale turnover or gross receipt is between rupees 1 crore and rupees 10 crore. If not, is it below 1 crore or exceed rupees 10 crore? So this is an additional disclosure that has been inserted. The new ITR return form require aggregation of receipts and payment in cash and non-account pay check or DD while computing the limit of 5% as mentioned above. So these are some of the additional disclosure, and why these additional disclosures are to be made, that also I have discussed. That for this particular reason, you have to select those check boxes that would be available in the ITR 3, 5, and 6. You would see these check boxes as the new checkbox in the return form. Next changes to ITR 5. So this is specific to ITR 5 only. Deduction of capital gain under section 45(4) attributable to assets that are retained or that remained with the firm on dissolution. So the Finance Act 21 has made the partnership firm liable to pay tax on the business income or capital gain arising from transfer of assets to the partner on dissolution or reconstitution. The computation of income from such distribution shall be made as per section 9B and section 45(4). Section 48(3) allows an additional deduction for capital gains charged to tax under Section 45(4), which is attributable to capital asset remaining with the firm. The CBDT has inserted Rule 8AB to prescribe the manner in which such attributable amount is to be computed. The new ITR 5 amended Schedule CG to disclose the deduction allowable under Section 48(3) in respect of the capital gains that is charged under tax under Section 45(4), which is attributable to the capital asset that remained with the firm or that is retained by the firm. Again, just a disclosure requirement where the deduction has to be shown up under Section 48(3) separately for the firms where the assets have retained or they have remained with the firm post its dissolution or reconstitution. So this is specific to ITR 5. Again, a small change to ITR 5, disclosure for new alternate tax regime opted under Section 115 BAD. We have discussed this in the cooperatives section ITR 5 as well. So if you have opted for ITR 5, where a cooperative society has opted for an alternate tax, it has to furnish the AY in which said option is exercised. Again, the form 10IE, which was there for individuals, 10IF with the acknowledgement number has to be furnished. Where a society is choosing to opt for an alternative tax regime this year, it has to furnish the date of filing the form 10IF with the acknowledgement number. The similar provisions that we have discussed in 115 BAC, not much of a difference. Now moving to changes that are specific to ITR 3. Schedule 80 GGA for partners deriving only profit from the firm. That is, they are deriving just profit from the firm and they are not having any other business incomes. So Section 80 GGA of the Act allows deduction in respect of amount contributed to specified association or institution. This deduction is allowed to an assessee who is not having any income taxable under the head profit and gains of business or profession. Schedule 80 GGA, that is detail of donation for research, scientific research or rural development, has been inserted in ITR 3. This schedule is applicable in case of a partner of a firm deriving only profit from the firm. The following disclosures are required in the schedule if a partner of a firm seeks to claim deduction under this particular section and is not earning any business or professional income except the share of profit from the firm. Relevant clause under which deduction is claimed, name and address of the donee, PAN of the donee, amount of the donation in cash or other mode, and eligible amount of donation. So basically, it is now allowed because they are not considering partners who are drawing just profits from the firm to have a income under head PGBP, and that is where they can very well claim the deduction under Section 80 GGA. And for that particular reason, it's as it is a donation, and in case of donation, we have to take the details as we take in case of 80G, and that are the more or less the same details that are there, whether it is donation, eligibility, name of the donee, PAN of the donee, etc. So this has to be made in ITR 3, and that is where 80 GGA can be claimed by those partners who are just receiving share of profit from the firm. So changes that are specific to ITR 6, that is for companies, disclosure of interest income at concessional rate of 4% under Section 194 LC. 194 LC provides specified company to deduct tax at a concessional rate of 5% from interest paid to non-resident. The tax is deducted at concessional rate if the borrowing is made before 1st of July 2023. The Finance Act 20 has reduced the rate of TDS to 4% in respect of interest payments to any non-resident against borrowing in foreign currency, though issues of long-term through issue of long-term bonds and rupee-dominated bonds, which are listed on a recognized stock exchange in any IFSC. For IFSC, there are certain advantages that are flowing in, and instead of 5%, the rate was made to 4%. The new ITR form makes the consequential changes in Schedule OS, other sources. A new row has been inserted, scheduled to disclose the interest referred to in 194 LC, which is taxable at the rate of 4%. Again, a distinction has been made. Earlier, everything was to be reported together. Now 4%, 5%, the disclosures would be separate and the calculations would be automatic. Next, disclosure of income of FII, that is foreign institutional investor and specified fund chargeable under Section 115(8). Section 115 contains special regime for taxation of FIIs and specified funds. It provides that dividend or income earned by the FPI is chargeable at a special rate or concessional rate of 20%, where interest income is received or receivable in respect of investment made by the FPI in rupee-dominated bond of an Indian company, government security, or municipal debt. The Section 194 LD would come in place and the reduced rate would get applicable, that is 5%. In case of specified fund, again, the concessional rate is 10%. The new ITR form, again, the same disclosure separately defining that the schedule of OS has been modified, and the new ITR form has been amended to incorporate the certain change in the similar to what was before we discussed. separate disclosure of income from units located in IFSC in Schedule MAT, that is minimum alternative tax, is payable by companies whose tax on total income is less than 15% of book profits. However, if the company is a unit in IFSC deriving income solely in convertible foreign exchange, the alternate minimum tax, it should be minimum alternative tax shall be 9% instead of 15%. Again, reduced provision for IFSC. The new Itr Form Schedule MAT have sought separate disclosure of computation of adjusted total income under Section 115JB. For AMT, it was 115JC. For MAT, it is 115JB for, again, units located in ILC and other units. Same, everything is same. The Itr form is different. Now, the income from unit located in IFSC shall be reported separately in the Schedule MAT for computing the book profits and tax payable there. Next, disclosure for alternative tax regime opted under 115BA, 115BAA, 115BA. The following disclosure are required in ITR 6 in respect of alternate tax regime under BA, BAA, BAB. Where the domestic company has opted for alternative tax regime, it has to furnish the AY in which said option is exercised for the first time and the date of filing of the relevant form IB, IC, ID, same as IE and IF for cooperative with acknowledgement number. No much of a change, same thing that is coming up. Where the domestic company is choosing to opt for alternate tax regime this year, it has to furnish the date of filing of the relevant form with acknowledgement number. That is also the same thing. Not much of a discussion. New schedule IF inserted to seek the disclosure of investment made in incorporated entity. The new Itr Form 6 inserted a new schedule IF, that is information regarding investment in unincorporated entities, that required the companies to disclose the following information in respect of investment made in unincorporated entities: name of the entity, type of the entity, PAN of the entity, whether the entity is liable for audit, whether Section 92E is applicable to the entity, share in the profit of the entity, and amount of share in the profit, and last, capital balance as on 31st of March in the entity. So this new schedule has been entered in for unincorporated entities where the entity has made an investment in this company, and therefore the investment disclosures have to be made for that particular unincorporated entity. So that is a tracking provision basically. This particular change has been made just to track. Now change is common to all return form, that is Itr 1 to Itr 6. There is just one change: removal of reference of Section 153A and 153C for Itr filed in response to a notice. Now, why is this done? Inspection thing has been removed. Section 148 notice is there for this, and 153A and C is not of no resource, and therefore the check boxes have been disabled. That is what I have written in the discussion also as per old provision. Where search is initiated under Section 132 or books of accounts, other documents or assets are requisitioned under 132A. The assessment was made in case of an assessee or any other person under Section 153, 153A and C. The Finance Act introduced sunset clause, and accordingly the provision of A and C were made inapplicable from 1st of April 21. Where search is initiated or requisition is made after 1st of April 21, the assessment, reassessment, recomputation will be made under Section 147, and the notice for the same shall be issued under 148. Hence, the assessment shall now file its return in case of response to a notice under Section 148 in the new Itr form, and not under 153A and 153C. And therefore, the check boxes of 153A and 153C for the filing status of the return income have been removed. Very much clear. Last thing, furnishing of the return has been made mandatory. What is Rule 12AB? So this has been notified recently on 21st of April 2022. So what are the clauses or what are the things that are there? So if we remember that it has been like 2 financial years when the 7th proviso to Section 139(1) was introduced. So what was there in 139(1)? Certain people were required to mandatorily file ITRs even if their income was not crossing the threshold limit that was defined under the Income Tax Act. What was that threshold? What were those conditions? If there was foreign travel expense of a certain amount, if the electricity bill was paid of a certain amount. So there were 3 conditions that were there, and a 4th condition was also there: any other specific or any other condition. Taking power from that particular condition, Rule 12AB has been inserted, which now contains certain other mandatory requirements or conditions, fulfilling which every person is required to file this ITR even if his income is not crossing the minimum threshold that is required for filing the income tax return. What are these conditions? The condition for furnishing return of income in respect of person referred to in clause B of section 139(1). So this become all the assessees excluding the companies. In terms of clause 4 of the 7th proviso to section 139(1) shall be the following. So 7th proviso, clause 4, as I'm talking about any other, and for that they have taken the power and they have made this particular. If his total sales turnover gross receipt, as the case may be in the business, exceeds 60 lakh during the previous year, in that case he has to mandatorily file his return, whatever his income be at last. If his total gross receipts in profession exceeds 10 lakh rupees during the previous year, I hope all professionals will now be required to file the returns, because in an entire year, I am definite that all professionals have their receipts exceeding rupees 10 lakh. If the aggregate of tax deducted at source and tax collected at source during the previous year, in the case of a person, is 25,000 or more, TDS plus TCS is equal to more than 25,000. In that particular case, return filing is mandatory. Now, I don't understand why this provision has been made otherwise, because if you are giving an exemption for TDS deduction, I mean, 25,000 amount is too much of they are asking for. They are requiring everybody just to file those particular returns. They are not sparing up anybody to file. And I seriously feel personally that ITR filing is also very important for every one of us, because not only it is creating like applicable like allowability of loan or foreign travel, but otherwise also it is a good source to keep everything reported and under a clean channel, or what do we say, a white money thing. So it is always good to report everything to the government and file an income tax return. My income tax return started to get filed. My father was filing it that time when I was 18. When I became 18, my birthday stands in March. So on 31st of March, when the financial year closed for my age to turn 18, so that year my return of income was filed by my father. So every person should file their income tax returns. That is very much required. There is no need to follow these particular conditions that have been given. Just suggest everybody to file up their ideas. 99% of assessees are getting their TDS deducted by the banks by not filing their ideas. So advise them to file the returns to get even the refund of that TDS that has been deducted. The deposit in one or more saving bank account of the person in aggregate is rupees 50 lakh or more during the previous year. In one or more saving bank account. So all the banks in talking in particular in aggregate is rupees 50 lakh or more during the previous year. So when we are talking about deposit, it does not mean cash deposit. It even means bank transfers. So if 50 lakh is getting crossed, then also you have to file the income tax return. And this could be even your the amount that is coming from your father to your account, say that deposit can be coming in, that would be tax exempt otherwise. And that could be in pieces. Say your mom has given you 10 lakh, or there is a property purchase in your name that is required and you required funds and you took loan from your father, or your father gifted you that particular amount and the amount came into your account and it became more than 50 lakh, or in total the amount became more than 50 lakh, then also filing of ITR becomes necessary. Provided that smaller exemption, for smaller exclusion for senior citizen, they have considered this amount of 25,000 that is there in the limb 3 for TDS and TCS. This becomes 50,000 in case a person has attained the age of 60 years or more in case of a senior citizen, basically. So this is all for today. We have discussed entirely whatever all changes are there in the return forms that are coming up. These are my details. You can note them down. You can WhatsApp me your queries if there be coming any, and you can also fire me an email, or also you can post your queries to Optotax channel. They are extensively available on the social media networks. I am also there on all social media channels, so you can definitely contact me. Whatever queries are there, we can definitely discuss in detail whatever your queries are. But after so much, I guess, detailed discussion, whenever you'll be seeing those ITR return forms, then it would be very clear. Just taking one more minute, let me see if I can show you guys what I was wanting to. Yes, these are the ITR return forms that we were talking about. So we noted a change that came in where I told you that there is pensioners thing that has been requiring further reporting. So you see pensioners, capital central government, pensioner state government, pensioner PSU, pensioner others. So this was a change that we discussed about in ITR 1. And also we discussed up a change, if I remember, for 89A, that is income from a retirement benefit account maintained in notified country. So see the schedules and see our explanation. These details are existing in here. Also, if we see this schedule other sources for the dividend, we can see that not in ITR 1, but if I show you ITR 2, ITR 2, I'll just show you like for a brief intro. Just give me a second. See the residential conditions. Now you have to check your box accordingly. Whatever the resident condition is being applicable to you. Check box 1, check box 2, check box 3, 4. Resident but not ordinary resident. These check boxes, the non-resident, this was same. This was already existing. There is no much difference here. In A and B, there is difference. Okay. And you can see the details in here also. Just give me a second. I'll show you. If you wish to see the capital gain schedule, let me show you that. So this is the schedule capital gain. I'll show you the details where we have to mention this zip code now for the property. And also for the purchase, let me show you date of purchase. See, for long-term capital gains, there is from sale of land or building or both, there is date of sale or transfer, and there is date of purchase and acquisition. Also, let me show you something for 222E that we talked about. So see, the dividend bifurcation is there, dividend income other than 2 and dividend income under section 222E. Specific reportings have been made. All the data, all the detailed everything we'll find by seeing these ITR return forms in detail. I'll share up my presentation also. You can very well refer it, and it is like nearly everything is covered up in that. We have not missed anything. And also, if I like to show you one more return form, just give me a moment. Yes, in ITR 3, let me show you this. See, for I'm talking about BAC 10IE. Yes or no? Option for current assessment here, opting in now, you are coming up, not opting this time, continue to opt out. Except for this, if you select anyone, you have to furnish the date of filing of Form 10E, then you have to give the acknowledgement number. It might auto-populate also, but there is this particular condition that is coming. Then it is the conditions that are there. And if you see this particular condition, are you required to file a return under section 4 of 7th proviso? So this is what is rule 12 BA is actually. So here also you can see an additional thing. Earlier there were just 3. So this has been added up. Again, residential status and everything is in common. And so there are things, again, see if you can see date of purchase, date of sale is there, address, zip code, everything is in place. So you can definitely go through these return forms. And if you come across anything that is there, so you can reach out to me. And with this, I conclude the session for today. I guess every time we are limiting the session to 1 hour and it goes to 1.5 hours. So thank you so much, Optotax, for inviting me. Thank you so much, Rohit. So,
thank you so much, sir.
I'll hand it over to you now.
Yeah, thank you so much for this very insightful session, Ujjwal sir. It was really a delightful session for all of us because it was full of knowledge, and I guess each and everything and every changes and alterations were covered. And definitely, if the audience can find any other changes which have come, definitely you can reach out to us. It will be you will be more than welcome. So please let us know if there are any changes. And finally, thank you for this insightful and intellectual session. Because all of your love and support, we promise to keep coming with such interesting and learned topics for all your professional growths and learning. So to all the participants who missed today's session, can reach out to us at our Optotax YouTube channel. So it will be recorded, kept there as well on recording. So that's a good news for you as well. And there are other learned topics available there as well. So if you like it, please don't forget to hit the bell icon, and you can also subscribe for regular and knowledgeable updates. So that's it. Please stay connected, keep using Optotax, and thank you for this delightful session again. Goodbye.
Thank you so much.
Keep healthy. Yes.
Bye-bye.
Okay. Good night. Good night.